One of the biggest mistakes that I see other tax professionals make every single year and way too often is when a business owner brings their tax professional their financial statements for the year to go prepare their tax return. The tax professional often fails to make what's known as an accrual to cash adjustment before they report the profit and loss activity on that tax return for that year. What in the heck is an accrual to cash adjustment? So, 98% of business owners will keep their financial statements, in QuickBooks on an accrual basis of accounting, or at least for the most part they will. And they won't even know it. It's just a natural thing that happens when you go and use all the features of QuickBooks. If you go into QuickBooks and then you create an invoice for a customer and you send that to their email and then you're waiting a couple days for them to pay you and then they pay you, you are keeping your financial statements on an accrual method of accounting. So the issue becomes when the tax preparer doesn't make the accrual to cash adjustment, they're actually misreporting your cash basis income. For example, let's say that you send out a bunch of invoices for December 31st, $100,000. And then you don't get paid for those until January the next year. Time to prepare your tax return, okay. You print off your profit and loss report, hand it in to your tax preparer. In that profit and loss report is $100,000 of accrual basis income. If you don't make the adjustment to take the $100,000 out and bring the income to cash basis, then you just made this taxpayer pay more in taxes than what they should have. So ultimately, what do I think about having your books on an accrual basis and then on taxes, you're on cash basis? Yes, for taxes, you should 99.5% of the time be paying taxes on a cash basis as a business owner and investor. And for your financial records, it really depends. Like I said, as a business owner, if you just go into QuickBooks, you create invoices, you send them to customers, just by a natural nature of using QuickBooks, you're using accrual method of accounting. But at the same time, if you take your insurance and you prepay it for 6 months in December of 2024, chances are you're just going to go into your QuickBooks and record it to insurance expense just for the month of December, and that's cash basis accounting. So oddly enough, most clients end up just by natural accident using a mix between kind of accrual method and cash basis accounting. And which one's better? Well, that kind of comes down to a preference of, the business owner. Who are the financial statements being presented to? Who is the audience of the financial statements that, are in QuickBooks or whatever software the company uses? Do the owners want to track book depreciation on their financial statements? Do the business owners want to really try to do full-fledged accrual accounting on their financial statements? Do they need to? Are they going under review? Are they going under an audit? Like a whole bunch of everything else, it depends.